I'm Cici with Redfin. I work as a real estate agent here in the Bay Area. And Jason.
I'm a loan officer. I figure out the numbers to help you get you into a home. I figure out the financing and get you the money.
So we're here today because we wanted to share with you guys just what we see on the regular basis. There's a lot of questions that I know a lot of you might have that maybe just don't come up in regular conversation, but Jason and I were talking yesterday and we realized that we probably have a lot to share that would be very useful and very helpful for you navigating what your next steps are if you're looking at purchasing any property in the near future.
We got the answers.
Basically. So, go ahead.
Well, the first, probably the biggest topic on mind right now is going to be mortgage rates. Now, a quick little pulse on the industry, the mortgage rates in general. Rates are trending downward. Just from last Friday to today, the national average based on Mortgage News Daily survey, rates have gone down almost an 1/8%. That's 0.125% just in the last 4 business days. The trend is likely to continue, and things are looking great for mortgage rates. The biggest thing that is on the market for the future of mortgage rates is going to be the Fed's meeting next week.
That's the hot topic. Everyone's talking about what is Jerome Powell and everyone at the Fed going to discuss that may or may not impact, and when I say may not, I mean may, impact the interest rates in the mortgage market. So what do you think people are looking for that meeting next week?
Well, as economists or as people who's looking at the finances, we're going to be looking exactly what he is saying.
Mm-hmm.
The expectation of what he's going to be doing is going to be reducing rates 0.25%, 0.25%. That's the expectation. Now, that expectation is already factored into today's mortgage rates, which is why they've been coming down over the last couple of weeks, because the expectations are he's going to do that. But what we're going to be looking at is what's he saying about the second rate cut, the one in December or January or February next year. That's what we're going to be paying attention to, because that is going to determine, are we going to keep that downward slope or are we going to level off and stay here for a while?
And I think that's a big question that I'm getting on my side as far as on the housing market, where the inventory is going. Because typically what's traditional is we'll see a cycle after the summertime, after we do this Labor Day, kind of everyone's motioning towards going back to school, getting a little bit more settled, is generally the inventory in the real estate market will kind of start to soften and we'll see less homes available. However, with this chat going on with this Fed rate cut coming up next week, just because of the news, and that's where a lot of our cycles come from, a lot of sellers and buyers are both waiting for that occurrence to happen. So as Jason said, we're already on the downslope, but on the buyer side, people are wondering how much more money they'll be able to save and be able to afford in a monthly payment if those interest rates go lower. However, there's a lot of people having that conversation at the same time, and the sellers know it. So sellers who are considering bringing their house to market, one thing, people in this area, people in the Bay Area have so much equity, they can wait. They're not in a rush to get if they want a certain number, they'll wait till the market can respond.
And most of those people selling the house, they have those teaser COVID rates that you're not going to get again. So they have a ton of equity and they have unusually low payments. They can wait and sit out the market. The ones that are selling today, it feels like those are the ones that need to sell earlier. And if you can take advantage of that, that's where you really want to be as a buyer.
And that's why we have a lot of this limited inventory, because if you're sitting on equity and you're sitting on maybe a 2.5 or 3% interest rate in the environment that we're in, they can wait until they get their magic number. The question is it worth the wait, and are they going to get that magic number? Because what we're seeing right now is in our market right now, right before this big meeting, things are a little bit cooler. Houses are on the market a little bit longer. There's not as many buyers out there being as competitive as there might be, right? We don't have a crystal ball, but we're doing a very good educated guess. Probably a lot of people are going to come out of the woodwork after this meeting should the rates be impacted lower than they already are, because we're already floating below 6%, give or take. So I think that sellers are going to wait and to see if the buyers come out from being on the sidelines from all year. Then they'll release their inventory to create more demand, which might mean prices get impacted too, because if there's more buyers out there, there's going to be more competition per house, and sellers know that too.
I very much agree. I think a common issue or a common misconception is the idea that if I wait, I might save money. Rates might come down, but they're not likely to come falling off a cliff down. It's gonna feather slowly coming down to the ground, And as you wait for that to come down and come down, the prices in the market are likely going to keep ticking up. And that is where I think is probably one of the big questions that people ask. It's, should I wait to buy, right? I mean, that's probably a question. Should I wait? If rates are going to come down, should I wait? And I feel that's a big, not fully thought out concept, because as you wait, that demand's going to go up because rates are coming down. It's making it more affordable for people. But that's also meaning that the sellers are going to have more buyers to choose from. The sellers are going to be more selective of who they sell their house to, and they're going to be able to make more money and sell it to you more expensive. So while you're worried about an interest rate that you can change, you can refinance and replace, you're not going to be able to impact that purchase price.
And I think that brings us to our client question of the week, because to Jason's point, if that price point to get into the house, we're talking about increasing demand and increasing competition. Right now, a hot house that's really well positioned, turnkey, ready to go in a good location will merit anywhere. I think the last time we went into something hot, we were like one of 9 offers versus another home that maybe doesn't have all the bells and whistles. Maybe we were one of 2 offers. If these rates impact the demand coming into the buyer pool, those one-offs of being one of 2 offers will probably be one of 4 offers. And if that one hot home got 9 offers in this cooler market, imagine what that number will be when there's more people willing to play into writing offers on a house. But to your point, a question that I've been getting is, if we're in this weird market flux right now and we're active and we're ready to buy, do we spend more right now to get the house and then refinance in a year, give or take, where the rates are then? Or do we continue to wait? And I think that hurry up should be a virtue as much as patience is, because if you have to get the house first. And if right now you're only competing against the 1 or 2 people that are offering on that same house, the affordability on a monthly payment is going to shift when you're competing against 4 or 5 people for that same house. So if we're talking about a difference of maybe $50,000 or $100,000 on that house, if it's about the monthly payment, the purchase price might go up because there's more people willing to pay it.
A higher price is going to have a higher payment regardless of your interest rate. It's just the math of it. If people ask me, so should I buy? And my answer is buy the house. If you're financially stable, if you are comfortable in your finances, your job, your employment, you have a comfortable outlook on your finances, buy the house. Rates are going to go up, they're going to go down, likely down. But as you wait, those prices are only going to go up. There's only so much land, especially here in the Bay Area. There's only so many homes that are here, and they're not making more land.
Right.
And as you wait, those prices are going to go up. You're wasting money on rent. And when you're looking at a house, it's an investment. An investment is not a get-rich-quick tonight type thing.
Right.
It is something you measure out over the course of 2, 3, 5, 10 years. The people that bought, even if you bought your house at the height of the housing pandemic or the housing bubble in 2007, where they were doing crazy no income verification, no asset verification, anything like that. If you bought at the height in 2007, but you somehow held on to it and the market crashed right afterwards, that same house here in the Bay Area, 3 times your net investment. That $200,000 house, easily $600,000 today. Even through the biggest economic crash, if you're able to hold onto your property over a few years, and the average person lives in their house 12 years or something like that, you're gonna come out ahead. And that's why if you're in a good situation, you're able to buy the house.
Yeah, I think getting into the house is going to be the challenge that seems to be what's happening for people now, of being indecisive. Do I want to pay more now, or do you want to pay more now, or do you want to pay much more later? Because that house that's sitting there that maybe didn't get any offers might take a break, come off the market, come back in January and get multiple offers. So it's not necessarily a rush and hurry up. It's more so, to Jason's point, if you're prepared, you've run your numbers, you've had your conversation with the market temperature of what the realistic expectation is on your purchase price, and you've had this conversation in regards to what your realistic expectations are on your monthly payments and what the financing looks like, take your best opportunity when you're not fighting against multiple offers. because we've seen that happen when we were one of 17. I remember then. Being one of 2 is a great advantage. And if being one of 3, one of 4, and as these rates, like we said, if Jerome Powell and his friends decide that those are going to continue to go a little bit lower, people might still be hanging on to the weight. Or maybe it's the new year, new me energy that comes into January. Guarantee it, with that new energy is going to be more people coming into the market. And to your point, what did you say before as far as if the interest rates fluctuate, by what percentage more people come into the market?
I think it was for every 0.5% rate, affordability goes up for like 50,000 buyers. That's a national number, but that's a lot more competition.
That's the U.S., okay? And
That's
we
a-
are in our micro bubble here, so people
But
move
it's a big
quicker.
bubble.
Yes.
It's a big bubble.
It
We're going to
is.
get a bulk of that 50,000 more people. It's going to be that much more competition. If you can avoid it, avoid it.
So I think the moral of the story is if you want to compete, compete in the Olympics, not in the housing market. Are we done?
That was a good Olympics.
Snoop likes it.
Well, I got to say,